Hello everybody, this is Jackson here at the Wealth Squad. Today we'll be talking about what to do in a bear market when it comes to buying stocks. So what I've been saying a lot past couple of weeks, past couple of months, is to buy risky stocks in a bear market, in a crash. Well, it doesn't have to essentially be a bear market, but any type of crash, any type of dip, the risky stocks will return the most. The risky stocks will grow the greatest. That is what has happened. That is what is happening, and that is what will happen in the future. We're looking at a firm right now. You can see a firm once hit a high of 178, 180 around there. You can see the low is $13. So sure, a firm is down a very, very considerable amount since that very high 52-week high of 183. It's down 83% at one time, or right now, down 83%. But from the low, and what you're doing is catching a falling knife, but from the low you're up 115%. And this is what I'm trying to talk about when it comes to risk and reward. Risk, you're risking, let's say you buy it at 13 and you say, all right, I'm going to sell at 10, right? You're losing a considerable amount. Let's say, you know, around 30%. It's not 30%, but it's around there. And you're risking 30% to make, let's say you buy it at 13, you'd sell at 10, and you also sell at 20. So right then and there, you're making, it's a 2-to-1 bet, right? You're risking $7. You're risking $3 to make 7. So when it comes to a stock like this, sure, you're risking $3, but you can make a lot more than 7. Right here, you're making 20 or 17. You're making $17 off of a $3 risk, because if you risk $3 and that's when you're going to sell at 10 or at 11 in this case, then you're only risking 3. You're not risking the whole share price. But when it goes up like this, you're only risking $3, like I said. So your upside is, in this case, 17. 3 to 17 is a great ratio that you should take every single time. And when it comes to a firm is a very risky stock because it was once highly favored in the tech growth payment options industry and then fell out of favor due to this recession correction, whatever you want to call it. And even the bottom, the catching of the knives are making money. So let's look at some more stocks and I'll show you my example. Roblox is another good one. Fits the exact same chart as a firm almost. Let me exit out of that. But you could see the company's not in amazing shape, right? Who cares? Who cares? We're not trading for fundamentals. We're trading for technicals. We're trading for percentage. We're trading for dollar amount. We're not holding this long term. We're looking to sell within the year. So in this case, Roblox, the hard thing about Roblox is you can't really know the bottom, because past $60, that's the lowest it's been. So you have to go based on other stocks. If other stocks are jumping that day, it's likely that Roblox will follow. If let's say Affirm and Unity, which we'll look at later, are both jumping in that one day, it's very, very common and very, very, very likely that Roblox will follow suit. And what happens is, even if Roblox is down, from 140 down to $40, it's less $100 a share. This little bit from 21 to 40, that's a double. Guys, you're missing out on a double. Sure, it's only $20, but you put $1,000 in that versus $1,000 at 100 or 140, and the percentage here is still much greater. You could have this personally in your head, right? You're gonna buy it at, let's say it was 20 instead of 21.65. Let's say you buy it at 20, you sell that 15 if it goes down to 15, just so you cut your losses. That's a 25% loss. But you say, all right, I will also sell at 30 if it hits 30. Buy it at 20, sell it at 30, and stop loss at 15. That's a 2-to-1 bet that you are taking. In this case, right, it's at 21. We could say we'll sell at 15. That's a $6 bet, and we could sell at 40. Well, it's $40 right now. We doubled our money and risked $6. So 6 to 20 or 6 to 18.35. And that's essentially what I'm trying to show you guys, is the risk reward on these is sometimes very, very favorable, that you should look into them. We've talked about Affirm, we talked about Roblox. Let's look at Unity. Unity has been hit heavily. You can see back then this was a very strong support, recently broke that, but I do not believe Unity is down for the count. I think it has room to grow. Let's check the last 3 months, let's say. From the low of 29 up here, we're up 40% already, and that's, you can barely even tell. And that's the best thing with these companies, is they could double from the low and no one will care, because they're down 90% from the high. They could double from the low, but no one even cares to look into it because they've already come down so much since the high. And the fact of the matter is, this is where people make money. A 40% gain in 68 days is not very good, right? That's less than a percentage a day when you're taking on a big old risk. But these movements day in, day out, from 30 to 47 to 32 to 46 to 37 to 44 to 31 to 40, when people think the company is dead and you're swing trading it essentially and you're making bank, no one is really gonna look your way and be like, oh, I want to do that, because you're taking on a risk, right? You're buying at 40 in hopes that it doesn't go next week to 30, right? You're risking 25% for whatever upside that you're betting on. Let's say you could buy Unity now for 35 and hold on to it. It would not be crazy for it to go back into this range in the 60s, and that's a double from 35 essentially. And these are happening everywhere, guys. I will show you what I basically base this off of, and this is extreme circumstances, but Penn National Gaming, a couple years ago, March 2020, one of the best bets you've ever could have made in your entire investing career. Let's actually zoom out. Perfect. Okay, so you can see here $37 before the crash. During the crash, it fell to $4. It fell to $4. So it fell around 90%, 85, 87%, whatever. So at $4, it went all the way up to 140, where your return in 1 year is 3,120%. And that's extreme, that someone could buy it for and sell it 140 a year later. That doesn't happen very often. In fact, very rarely it happens. But even if you buy it at 4 and you sell that at 20, you're still up a ridiculous amount. That's not right, but 443 to 20, whatever. You get my point. You're up a considerable amount, even though you've only captured a fraction of the overall return. And if you buy it at 4, you could say to yourself, all right, this is a less risky bet because it was once worth $36 and I'm buying it at 4. So I'll say, sell that 3, right? That's still 25%. It doesn't, 25% is not bad, but it seems a little bit conservative just because it's $1. But anyways, you buy it at 4, you sell it at 3 if it hits 3. But you can also just forget about it and come back to it a year later. Or you could just say, all right, if it hits 10, I'll sell, right? You make 2.5%, 2.5 times your investment when you risk 25%. So that's a 10-to-1. And that rarely happens. And in this case, it happened much, much more than that. So what I say to these people buying these companies at 90% off is to hold on and swing trade these guys. And in this case, if you held longer, you're still up a considerable amount even after 2 years, right? You're still up from 4 to 33. And the chance that you're going to get a trade like this is not very common, but the chance that you're going to make money from a somewhat decent stock that was once 100 and is now trading for 10 or 12, that's pretty dang high. I think there's chances on making money on that is high. But I want to hear what you think. What do you think of investing in risky stocks during a crash like this? I'd like to hear what you have to say. Thank you for watching, and until next time, I'll see you Friday.